So good morning again. I didn't get to say it, but it is great to be back here in Boston. I don't know if all of you know, but Bloomberg Radio is actually on 1200 a.m. here in Boston. And it's been kind of great for us. You know, we're obviously based in New York, but by having a station now in Boston, we really kind of tie in a different perspective, and we get different views from folks who are based here. And it's, as journalists, given us a good perspective, kind of thinking outside the New York metro area, which I think is a great perspective, but it's also good to get thoughts throughout the country. And I feel like this event does the same thing. I end up talking with CFOs, financial professionals from small, medium, large companies from this incredible panel that MIT puts together. And I get insight that is new sometimes and a different take on economic trends, things that are going on around the world and the country. So we're lucky to have this panel and this event. In terms of over the past year, it's been quite a year, a lot of things going on. A stock market rally, we've got a healthier IPO market, we've got tech IPOs, social media IPOs. Is it a top? We're all wondering at this point. We have real estate bidding wars again happening. We have conflicts overseas, national security leaks, lots of things. And we're still talking about what the heck is the Fed going to do. So a lot of things don't change in a year. But I love the theme here because powerful agility. To me, agility, you've got to be ready to do anything. And when I talk to CEOs, CFOs, I find the thing they always say that you can be certain about is uncertainty. It seems like that is just the one constant that we have out there. So with that in mind, we've got 4 terrific CFOs from different and varying industries to some extent. One represents the largest railroad in the eastern part of the United States that is going through a big transition. We're talking about CSX. We have the home of the much-loved Post-it note, which I love, and so much more. With sales, though, largely outside the United States, we get a good global perspective. We're talking about 3M. We have the largest U.S. drugstore retailer, Walgreens. They've been on an acquisition spree in the last few years, so we'll maybe dig into that a little bit. And we've got the family-founded Family Dollar, where most products can be had for $1 or just a few more. So an interesting retail space. As for who we have at the far end, we have Fredrik Eliasson of CSX Corporation. Then we have next to him Dave Meline of 3M, Mary Winston of Family Dollar, and Wade Miquelon of Walgreens. So let's get into it. So the theme is powerful agility. And Wade, I want to kick it off a little bit with you because back in 1901, a Chicago pharmacist named Charles Walgreen, he borrowed $2,000 from his father for a down payment on his first drugstore. He sold a half interest in his first store in 1909, bought a second, where he installed a large soda fountain, and he began serving lunch, and the rest is obviously history from there. It's a retailer, though, that's been in business for a long time, over 100 years. Staying power, but it's never a guarantee. Take a look at retailers like JCPenney or Sears. Yeah. So what do you do as a CFO of a retailer that you need to be really agile about to survive?
Yeah, I mean, in retailing in general, there's a graveyard of folks who haven't
Mary's
made it.
laughing because she's in retail too.
I think at the end of the day, though, I hope you can hear me now. I think at the end of the day, it's about being relevant. You have to be relevant to your customers. You have to be contemporary, and you have to play to your strengths. I'm sure we'll come to it later, but we're doing a lot to transform the chain off of our strengths, off of our capabilities. But I think that the quest is always about being relevant. And I was
always thinking about the consumer.
Yeah, and I think, if you go back to the book Good to Great, it was before my time at Walgreens, but Walgreens, I think, was one of 11 companies mentioned. I think there's less than 4 of those companies still alive. So,
It plays to what Jack said about the
S&P 500. So it's always about, reinventing
Yeah.
yourself, and you have to reinvent yourself in the context of your customers and of your constituents and of your strengths.
Mary, Family Dollar, another retailer. You compete with Wade a little bit in Walgreens?
A little bit.
And everybody?
A little bit, yeah. I would say we compete with everybody, so I would really echo what Wade said, and I think that's the mantra within retail anyway. I think the success to a retail business is staying true to what your customer wants you to be.
But consumers are fickle. I'm a consumer, and my tastes change often.
That's exactly right, which is why retail is probably one of the most fast-paced industries. Things are changing every day. They're changing overnight, and so the trick for a CFO is to be able to have that stable foundation in terms of processes, systems, metrics to measure the business, but at the same time not have so much of that that you hamper the innovation in the business and the information in terms of what your customer wants and the ability to react very, very quickly and change as the market is changing and as the competition is changing.
Reacting quickly is important.
Yeah.
Dave, agility very much the model of 3M. I think you said on our conference call, the act of disrupting yourself, it's an important thing to have at a company.
Yes, it is. So if you look at 3M, and Bill gave us a little introduction about the company, it's a company that's 100 years old, and the model is fundamentally based on innovation and continuing to reinvent the business, finding new markets, combinations of technologies, and continuously disrupting ourselves, because if we don't do it, we know somebody else will.
It's a lot of pressure.
It's pressure, but the company has a very good model that it knows how to continuously do that reinvention, and so it's also a very exciting place to work, because someone described it to me the other day as it's 1,000 $30 million companies. So we have 30 billion of revenue, but it's many small companies that are constantly growing and reinventing themselves, and in some cases will exit markets as they decline as well. So it's this continuous disruption that goes on in the business, which makes it a very exciting place.
Fredrik, CSX is going through a big period of transition. Talk to us a little bit about that.
Sure. So obviously we are blessed with a lot of new natural gas in this country, and it has really changed the model for a railroad, because the backbone for many years, century, has been moving coal, and just over the last, 7 quarters, we've lost $750 million of revenue from the fact that coal is not the kind of the primary source for electricity anymore. And what that has done is it has forced us to be agile. I guess for a century we've been powerful, but we now have to change, and going through that change model has been difficult. But frankly, we're coming out of this thing actually stronger than we've ever been, because we're now focusing on the growing part of the economy, much more service-sensitive businesses. And it really helped us. And I'm not sure we would have been as good as we are today if this didn't happen. We thought that coal will go away over a period of time, over a decade or 2 decades, really because of regulation. But within just a few years, because of this new technology, it happened within 5 years, what we thought was going to happen over basically 2 decades.
When you're going through a transition at a company, you've got to relay that message to everybody, and some people get it more quickly than others. How difficult is that, kind of working that transition internally?
Yeah, it's about transparency. I mean, whether it's internal or external, because obviously we have a large constituency outside of the company as well that is looking at see how we're adapting. But it's about transparency. It's about clarity of message. What are you trying to accomplish? And it's important, I think, that both of those 2 messages, both internally and externally, are very much aligned.
When we talked with Steve Sardella, we talked a lot about the financial crisis, since he came to LinkedIn just before. And I think, having been here for 4 years, we've talked a lot about the crisis and what it's taught everybody about running companies. And we all talk about how the balance sheets have gotten leaner and meaner, and corporate America has really cleaned up their financial houses. Dave, you came to 3M, I believe, in 2008 after being with General Motors Europe during the crisis. That had to be fun.
Yeah, it was quite challenging. So big change to come from the auto business in 2008, and actually joined the company in September 1 of 2008. And we then went into the financial crisis when I was with 3M. And as it turned out, the agility, the whole model is built on change and agility. So the company did very well through the crisis. We maintained our operating margins continuously above 20%, which was not very typical of an industrial-based firm. And we saw the recovery develop very quickly in 2009. So the fact is a model as we have, which is built on change, it's not only markets changing and us moving into different markets, but also being able to react to very quick change in the economy. So it serves the company actually very well.
Mary, what was your experience like during the financial crisis?
Well, it's interesting. I wasn't at Family Dollar. I was at Giant Eagle in grocery retail, where I arrived in 2008 as well, right before the financial crisis.
What is it with everybody that's moving right around that time?
And I think one of the biggest things I learned going through that is making sure your balance sheet is strong allows you the flexibility to manage the business without worrying about how you're going to finance yourself on an ongoing basis. So again, a retail business, very customer facing. in addition to the financial crisis, there were lots of things going on with the consumer because people started shedding labor, and so unemployment started to rise rapidly. Things started to become very tight for the customer. And so having a strong balance sheet, not having to worry about liquidity during that time, allowed the company the flexibility to be agile, to promote to the customer, to stay attuned to what the customer needed, and to make sure the business continued to thrive even during that time period. So that was my experience there. And I think, you know, with Family Dollar, knowing the history, our customer, the average customer, earns less than $40,000 a year. So they're very impacted by the things that happen in the economy, the uncertainty.
But they also benefited because people didn't have so much money, so they went to the
That's
dollar
exactly
stores.
where I was going. That's
Yeah.
right. And so as there was that disruption during that period of time, lots of people started to trade into our channel and started to discover what the dollar channel has to offer. And I think that was actually what started to put the channel on the radar screen, because before that the companies were somewhat small by comparison, and then all of a sudden they were large.
No, you're right. They got a lot of attention.
Yeah.
Wade, you guys had a pretty deep balance sheet during the financial crisis, didn't you?
We did. The company's historically had a strong balance sheet. I came in also in June of '08. It's the '08 club, I
See,
guess.
I'm not an idiot. They all do this.
And I think and the company was looking, senior leadership, the board was looking to go through transition and change, and then we had, Lehman and the entire crisis. And, it's interesting because then you start to get a little bit of fragmentation in terms of, do we retrench and go back? Do we move forward?
Right.
Because nobody knows what the world will hold.
It's also an opportunity when you've got a period where assets are being so beaten down, and if you guys have
Yeah.
a deep balance sheet, could be a buying opportunity.
No, I think so, and I think part of the key, though, to transition and change is, I think, first off, leaders have to have a good compass for creating value, a moral compass, whatever, to know where they want to go, and then you have to do that alignment of constituents. Because it's easy on paper to write it down, but it's hard to make sure that all leaders are bought in, all employees are bought in, the board is bought in, your stakeholders, your shareholders are bought in. And I think that's really what takes a lot of heavy lifting.
Is there something about a crisis, and Fred, you talked a little bit about, going through a transition and having transparency so the whole company gets it, but you go through a crisis and everybody, it's like all hands on deck. And if there's a mission to save the company or keep whatever you need to do people, do people get it more quickly?
I think, I've worked in companies that have had long track records of success and other ones that have struggled in the interim. And I think sometimes the more successful a company has been, the harder it is to create the burning platform for change. Because every company is going to have to evolve and change. It doesn't matter, how successful you are. But I think that, there's can be a reinforcing loop. And I think you just have to find mechanisms to get people to kind of understand that the world is changing, and then draw on that historical desire for people to win, to rechannel that energy.
Fredrik, so you talked about the transparency, but was it difficult, though, to get everybody on board as you go through the transition, or do people they see the numbers, they hear the numbers, they get it?
Well, I think to a large degree they did. There wasn't much of a choice. I mean, historically, a railroad, as you think about a railroad, you think about a very fixed cost structure. Mm-hmm. And what you are forced to do in an environment like 2008 is when you see that 20% of your volume goes away, and normal for us, if it's up, down 3%, that's a big year. And so what do? So we were forced to think just completely different about our business, and we were able to variabilize our cost structure in a way we never thought was possible. And as soon as people started to see that was possible, all sorts of other avenues open up as well. So we actually ended up in 2009 to actually have margin expansion. We didn't grow our bottom line, but we actually had margin expansion that year. And that was because we were actually able to take out enough costs that we just never had gotten around to thinking about it differently. So I mean, it really does open up a whole avenue. For a company that's been around for 180 plus years, change is hard. And when you have the same customer, 80% of our business is essentially the same year in and year out, and all of a sudden something like this happened, it really releases a lot of powerful agility.
I'm curious about, I just want to maybe show of hands in the audience, because of having gone through the crisis, does everybody kind of plan for another Black Swan event? Can I just see a show of hands? Does people think that there'll be something like this? Okay, a few people. As CFOs of major companies, do you guys all plan for another Black Swan event?
I would say that for those of you who are at larger companies, I mean, clearly the definition of stress test changed. I mean, as you stress test your balance sheet and you think about your capital structure, it used to be that you looked at your capital structure and you said, well, this is the lowest cost of capital. at this point. And usually we're in a good part of the cycle. But really for us, the way I look at this now is that you got to look at your capital structure through a business cycle. So whatever seems to be the lowest cost of capital and the best way to do today is not necessarily the way to look at it. You got to probably raise it up a couple notches because you got to go through that business cycle.
I mean, Dave, I think you mentioned to me earlier, you guys have a short product cycle demand, so you guys have to be able to react quickly.
Yeah, so we tend to sell products that are primarily consumables. So if you think about, as you mentioned, Post-it notes or sandpaper or materials going into production processes, or in our healthcare business, consumable products that are used in operating rooms. So we have then cycles of change which are very rapid, and therefore the business has to be geared towards that change. And in our case, we tend to take a lot of risk in the business, and therefore we've also found that a strong balance sheet is also quite a good match from a business model perspective, because we have heavy investment in R&D and capital expenditures, and we want to be able to maintain that through all the cycles. So strong balance sheet, agility in terms of the operating business, and quite honestly, my reaction to this discussion is in some way, it's difficult in a recession because of the difficult decisions you need to make, but there's clarity as to what you need to do, and oftentimes a more difficult environment if you're thinking about running a large global organization where it takes a while for the word to get out to the end of, the far end of the earth, is when you're in more of an environment like we've been recently where there's signs of improvement, but it's not quite there yet. And how do you interpret that to the organization globally? It's much more nuanced. Are you positioning for growth? Are you positioning for a downturn? So in many ways, I find it more difficult when you're somewhere in the middle than when you're clearly in a very strong uptrend or in a recession.
It sounds like from all of you that, we talk a lot about how people, coming off the crisis, that they're going to kind of forget what happened and leverage themselves up and take on the risk. None of you sound like you want to be in that position, Mary.
No, that's absolutely right. I think one thing that going through that process taught us all is, number one, you do have to be agile, but you have to have a downside scenario and a sense of if things do go down, whether it's the economy, in our case, consumer sentiment, consumer spending, all the things that could really impact the business, what's your game plan? And what are you going to do to course correct? And to what has already been said here, for our business, maintaining a strong balance sheet is critical, because we are a little bit of a hybrid in the sense that we're growing rapidly, so we are a growth company, in addition to being a business that's 55 years old. So we've been around for a long time, but we're still in a high growth mode. 2 years ago, we opened 475 new stores. Last year, we opened 500 stores. This year, we're opening 525. So in order to do that, we're investing lots of capital back in the business. And so we have to have the financial flexibility to make sure that we can continue to do that, because it's our plan to continue to invest in the business.
Wade?
Yeah, I think on top of having the financial balance sheet liquidity, I think it's just always asking yourself that question: if your company disappeared tomorrow, would you really be missed? Right? And you can find, but we're good companies like Circuit City, when they disappeared, it was a blink of an eye and where they really missed. And with disruptive technologies, with a lot of things happening in the world, that question can change overnight. And I think if you can answer the question, yes, you'd really be missed, you probably have a lot of options available to you even in a crisis.
In terms of disruptive things, healthcare, and that's something that you guys have to watch very closely.
Yeah.
You get a lot of your business from prescriptions.
Yeah.
With healthcare reform, how are you navigating through?
I think in general, we're transforming the company in a couple dimensions. One is globally, and the other one is really along the healthcare dimension. And we have traditionally played in 12 cents on the dollar, which is prescriptions, by being a traditional pharmacy. And we've been evolving through M&A, but also leveraging our platform. So now we're playing in largest player in vaccinations, moving into primary care with 800 clinics, and we'll get much broader than that. We're now partnering with Theranos to go into lab. We're the largest player in home infusion. We're a large player in specialty. We're the largest player in hospital campuses. So in much of healthcare in the U.S., because there's a lack of primary care physicians, a lack of infrastructure, we can do things that have been done historically more convenient, more affordable, more accessible. and with a very good outcome. And I think that's really the place where we're going to be disruptive versus other places where sometimes we get disrupted. So for us, that's a tremendous opportunity.
But in terms of healthcare reform, things can change in terms of reimbursements and stuff, and so you've got to be, talk about agility.
It can, but the big shift I see in the U.S. landscape is that traditionally the U.S. has been sort of a pay-per-use model. So people are fighting over, the opportunity to do a vaccine or to see a patient, but where you see healthcare going through individual plans, through managed care, through reform, and through a lot of other factors, not just HCA, is that it's becoming outcome-based. If you can do a quality outcome at a lower cost, business gets pushed to you, and it also changes the dynamic of how we partner with others versus compete. So in this, I guess it's a mega wave that I see that's going to lead to the retailization and the consumerization of a lot more healthcare.
I want to talk a little bit about earnings results, something that we all kind of obsess about a little bit, but I'm just curious from your perspectives. Taking a look at the most recent earnings quarter, you guys all either met or beat for the last reporting quarter. And yet, Mary, I think you mentioned on our conference call that you went from having comps of 7 to 8% to a flat comp last quarter. So that's been a little startling. Yeah. You've got Wall Street saying what's going on. You've got, I'm sure, you're trying to figure through.
Yeah, and it was a little startling, not totally startling. The dynamic we've had in our business is that we have had tremendous growth, in the teens in our consumable areas. So we've expanded our food and HBA offering and those offerings by about 40% over the last couple of years. So a part of it wasn't total flat growth, it was flat comp sales growth in that particular quarter.
Right.
And so that means the growth on top of the growth the year before, which was double digits the year before. So part of it was the cycling of that expansion. And the other big part of it was the pressure that our customer continues to be under in the economy. We do serve a customer that makes less income than the average, or our core customer anyway. We serve lots of customers, but our core customer does make less income. And there's lots of uncertainty right now, and they're still dealing with the fact that payroll taxes went up. There was the recent announcement about the SNAP benefits being adjusted, and that will impact a number of our customers. And there's just general...
That's the food assistance program.
Yes, that's right. And if you peel back some of the numbers from the recovery that we're seeing, there's two stories there. And a lot of our customers are not benefiting in the way the broader population might be. So customers who make less money, unemployment is just as high as it has been. Many of them have become discouraged and stopped even looking for jobs. And so all those pressures we have on our customers have impacted our sales on more discretionary items, not our sales on consumable items. And so that's what happened. And so to me, managing through that and still beating the earnings expectation
you feel good about it.
And it's an example of agility as well. Yeah. Because we as a management team rallied around, we saw what was happening with the customer. We looked at how we could adjust our business, how we could manage our expenses, and how we could still deliver the bottom line for our shareholders and our external constituents, and we did that.
Dave, what's your take on the quarterly earnings season?
The quarterly earnings season comes every quarter, it seems to me.
Do you hate it? Do you get through it?
Yeah, so for us, and I think it's true for any company, it's always decision-making where you're balancing investing for the long term and also delivering in the short term. So, and you're making decisions every day around those trade-offs, and really that's... as to the greatest value we can add as management is, in fact, making those calls.
Do you feel like people get it, though, when you go through the season? When people are obsessing about the numbers and you're often tasting it?
Well, I think what you find as a public company is you have all kinds of opinions, right? You have people who a long period of time is overnight. We have an investor base who, and our business is pretty complex. So if you look, we have a very strong investor base that's very long-term in terms of their investments in 3M. They understand how our business model works, and so they're very supportive of us continuing to invest to deliver long-term results and to continue to innovate. But we also have to be very clear that we can't take a year off and not continue to perform. So, as I say, it's always it's always finding that right balance between managing long-term and short-term, and we feel good about where we are right now.
Do you care more about the buy side versus the sell side?
I think all constituencies are relevant because you have the sell side, which is influencing opinion. You have the buy side, who are the people who are deploying the money. And we think they're all important constituencies that we need to stay in contact with.
Fredrik, what about for you guys? Since you're going through a transition, you're getting, you're being transparent, getting the message out.
Yeah, really, if you think about what is investor relations all about, it really is about making sure that you have the right to execute your long-term strategy. So I think it's important to make sure that you have good alignment and good understanding of what you're doing short-term, because you want to get through that quarter to make sure that they understand what you're trying to do. And really, IR, to me, is about trying to get value today for what you're about to do going forward. So once again, it's about transparency. It's about making sure that you're fact-based and make sure you're visible as a CFO. And so as part of this transition we're going through, I guess I'm almost overexposing myself in terms of visibility, because I'm doing 17 conferences and probably 15 days on the road with investors this year for this very reason, because what I don't want, and we've gone through a proxy battle 5 or 6 years ago, I want to make sure that our shareholders that are with us, the long-term shareholders that we all want, we want to keep them in there, and we don't want to create an opening for more disruptive shareholders, because really that costs the company long-term a lot of money, effort, sweat, and tears.
It's funny you say disruptive shareholders. What do you guys think of all these activist shareholders that are out there and have been shaking things up at companies?
Yeah.
Is it a good thing? Is it good if it's happening to other companies and not mine?
Look, I mean, I guess activists is probably a whole range of things.
Yes.
We've had some activists in our stock that actually have had a strong point of view. Sometimes it's been a helpful point of view, and sometimes we've been able to educate them that they should have a different point of view, and then they've been very constructive shareholders. We've had other scenarios that are a little bit different. I think at the end of the day, though, if you do communicate, if you reach out, if you can articulate your long-term strategies, if you can deliver on the short term as well, I'm not sure that the window is huge for opportunistic activism versus just very vocal shareholders.
And select. Mary, any thoughts?
Yeah, I think at the end of the day, it is all about returning value to shareholders. And so all shareholders, whether they be titled...
And you said to me, I think you think of the street last. You really are focused long term.
I really am. I try to focus on what's good for our business in the long term. What value is that bringing for shareholders? And then make sure the message to the street is clear and transparent, and make sure that our shareholder base buys into that, has confidence that we can deliver that, and that that's going to bring the value. There's no question we've had a history as well of various people in and out of our stock that might be labeled activist or whatever. And to Wade's point, I think out of that, in some cases, you do get thoughtful ideas that cause you to think about the business and add to your thinking. And in other cases, you are clear about what your strategy is and where you're going and how you're also going to balance and manage the short term, because you have to do that. I think in some cases, there's a tendency for that situation to clearly be a balance between long-term and short-term, because you frequently get people who are in the stock and the motivation is more short-term than what you can deliver over the long haul. And then there has to be a conversation and a meeting of the minds, so to speak. So I won't say it's a totally disruptive event. I think within a company can generate some thoughtful conversation and consideration of things you may not have been thinking about before. But I think at the end of the day, you need to manage the business to deliver long-term value for the shareholders. And the shareholders who appreciate that, that's why they will be in your stock.
Dave, in terms of activist shareholders, I mean,
Yeah.
there's been a lot of it out there.
No, that's right. And it's a very popular theme amongst multi-industry companies, which would include 3M. From my perspective, our view is that it's all about performance. And it's all about continuing to be clear, as Fredrik said, as to how we're thinking about running the company and creating value, and not getting off track and continuing to deliver and perform. So, we welcome all shareholders that are interested or prospective, and we have open dialogue with everyone. So, and at the end of the day, it's about us and it's about the performance of the company. which again, we feel very good about. And if I could just pick up Bill talk this morning about the issue of volatility, right? And using Lean Six Sigma to try to eliminate volatility in the results of the company. And what we came to learn as we went through that, and this was, if you go back in the early 2000 period, that for 3M, Lean Six Sigma is a very effective tool for organizing and leveraging the global capability of the company in certain areas. So in the back office, in our factories around the world, we run those factories using Lean Six Sigma principles, which in my view is the right way to run factory operations. But in the R&D space, where we've got innovation going on, you can't predict where you're going to see sparks ignite a fire. So you have to be much more thoughtful and provide more flexibility to continue to preserve that level of innovation that takes place. And you can't measure where those sparks will occur. So we're very careful about how we use those tools, and we've gotten the company to, I think, a very good place in that regard.
So it works in some ways.
Yeah, you have to apply it in varying levels depending on the problems you're trying to solve.
Fredrik, just any thoughts last on activist shareholders?
I mean, I think that, diversity of thought is always a good thing. It's not a bad thing. It is when it's constructive that it works. When it's not constructive, you need to do more and you need to do more faster, but there's nothing more behind it. And then all of a sudden you have a following, because that's what happens. You have one activist with a big name comes in, you'll very quickly see that 30% of your shareholder base all of a sudden wants the same thing, but nobody can really articulate what it is that you want. That's when it gets bad. But if there's specific business issues or, hey, you should spin this thing off, you can have a dialogue around it. But if it just do more faster, that's a little bit more difficult.
I want to throw out the topic of investments, and I think we touched upon it a little bit about how to decide when to invest in new technologies, when to revise a current product line or business line, whether to cannibalize an existing business or product, and kind of how do you mitigate the risk of long-term capital-intensive decisions. I think that's a big part of what you all do. Fredrik, why don't I start with you?
Yeah, I mean, so for a railroad, as I said earlier, 80% of our business is essentially the same year in and year out with now what has happened here over the last few years. So for us, our growth opportunity is around intermodal. It really is about taking trucks off the highway, and we are spending an awful lot of money on doing that. And really for me, because anytime we put $1 in, it really is for the next 40 to 50 years. So, and I recognize that my capital that I have, that I'm spending for growth could go back to dividends and share purchase or something else. So you got to make sure that you really not only have the right business case process up front, but you also got to make sure that you do a post-audit on it, because there's a lot of assumption that goes into everything that you try to do, but you really got to do kind of midstream post-audits to make sure, is this on its way? Because we're spending a couple $100 million a year just on opening up new terminals and expanding capacity, but you got to make sure that you have the right control process in place, because it is it's new and
it's a lot of money.
It's a lot of money, but and also obviously we're very different in a lot of the other you see here, especially with Dave, because we're new markets doesn't open up very often for railroads.
Right.
It's very different than in Dave's business.
Although in terms of new markets, I spent some time in Miami and the Panama Canal, the widening, and everybody up and down the East Coast widening their ports to accommodate it. And they've got a railroad link that they've opened up again.
Yep.
That's an opportunity for you guys?
That's an opportunity for us. We're seeing that. We're also seeing that the overall production in China is actually moving more southwest, which means the Suez Canal becomes bigger.
Mm-hmm.
For a lot of people probably don't see that, even for CSX, who's really just east of the Mississippi River, 2/3 of the U.S. population, 1/3 of our business leaves America, one way or the other. So we're very much, even though we're a U.S.-based railroad, very much integrated with the rest of the world and very much affected by things that happen around the world. So Panama Canal is one.
Dave, so in terms of how do you decide what to invest in? I mean, you guys, you're great. We love to study your company because you're involved in so many different industries. You kind of really are a bellwether for the economy. So you're making lots of R&D spending, a lot of investments. How do you decide which ones? How do you do it all?
Yeah, so generally speaking, so if you look at our business model, we're in a variety of end markets. So we're in consumer business, we have a healthcare business, industrial, electronics, very global business, 2/3 of the sales outside the U.S. and we have some 50,000 products. And the way we measure it at the corporate level is we look at the portion of our revenue in any year that's coming from products launched within the last 5 years. So this year we'll have a third of our sales will be products that have been launched within that 5-year period. And that's up from around 20% if you look back 6 or 7 years ago, picking up on where Bill left off on his story. So we've really, over recent years, been encouraging a greater level of innovation. We've been building out our laboratories around the world, so about half of our products now are originated in laboratories outside the U.S., in particular in the emerging markets, where they're close to customers in those markets and can understand their needs and tailor the products to meet their needs. So we're seeing a very nice rise in our innovation index. And as we looked at it, we got a new CEO last year.
And explain what that index is.
Yeah, so the index is the measure of the percent of our revenue coming from products launched within the last 5 years. So a third of that revenue this year will be from such products. And what I was going to say is we looked then last year with the new CEO, we stepped back and looked at, okay, what's working well, what could we do better as a company? And one of the things we could see is as the businesses prioritize projects in the R&D space, they tend to prioritize projects which are going to deliver revenue and income in a shorter period of time, like the 1 to 3 year type time frame. And then that tends to be more incremental innovation. So what we concluded was that there was an opportunity for us to step up the amount of investment we would do in longer term, more disruptive innovation. So we're planning to move our R&D investment from about 5 to 5.5% of sales up to 6% by the end of the 5-year period, which is a couple $100 million a year. And that's specifically focused on new disruptive platforms that we think could be very significant and new to the world type innovation that the company can bring forward. And so we've got about 20 of those we're funding right now, very much a venture capital type approach. Oftentimes those projects, we're partnering with incubators, so we have a couple, I think, in Bill's space here at MIT, as well as some of the other incubators you find around the world. And so it's really leveraging in, as he was talking about, an open innovation model, which we think can be very powerful for us to unleash kind of the next level of performance for the company.
I hear innovation, and I think, the creative types and entrepreneurial types. What's your role in that innovation or innovative process?
Yeah, so
Are you the guy who says that's too expensive?
Right. So if you go back and you think about the decision we made to raise that level of R&D spend, that started from a discussion that we had that I led with the R&D community, because what we could see was while the innovation index was moving up very nicely, and you could link that more directly to sustaining profitability, because the value proposition you offer with new products can be very strong, and you can see that linkage very clearly. What we weren't seeing over recent years was, with the rising innovation index, we didn't see the impact that we would expect it to have on our growth rate. And so we had a dialogue with the R&D community as well as our commercial people, and we concluded where we really had the best opportunity to start the impact on growth was by upping this quotient of long-term disruptive innovation. So my role is really to get to that intersection of financial results and investments with technology.
Kind of the sweet spot.
Yeah, and if you can bridge that gap, which typically in our company, any business discussion you're in very quickly turns into a discussion about technology and innovation and what are we doing, how are we going to bring it to the market, what's the business model we're going to apply. And so I'm an engineer by training, and that helps a lot because it's a very technology driven business.
My dad was an engineer. I get you. Mary, what about from a retailer's perspective? I mean, you guys are doing remodeling a little bit, right?
Yeah.
A lot of it, and you're growing. So how do you guys decide to, which investments to make?
Yeah, so for us, our biggest investments are growing our store base, and I already talked
Yeah.
about the number of new stores that we're opening. We do have a huge renovation program underway, and so our chain is over 8,000 stores. Many of them are new, a couple thousand of them are new, but we've been renovating and renovating every store in the chain, and our objective is in the next couple of years to have every store be either new or fully renovated.
It's important to stay competitive.
That's it. That's exactly right. That's exactly right. So that has been a huge capital investment that's directed toward improving the shopping experience for our customer. And so how we measure the return on those types of investments is what's the return we get out of opening all of these new stores? We've been asked the question, that's an awful lot of new stores, are you really getting the return from that? And because our box is so small, and people have been coming into our channel, discovering what we have to offer, our new stores reach almost the maturity level of the full chain in about a year and a half. So it's a great investment to continue to open the number of stores that we're opening. The other big area of investment we have beyond new stores and renovations is just our inventory. We source inventory domestically as well as from international markets to sell in our stores. And so the return on that is easy to measure because it's the margin that you make when you make the sale.
But it's tricky, that inventory management, right? You don't want to be stuck with.
That's exactly right. So then it comes back to the balance sheet of managing the working capital to get the inventory, managing the inventory levels, what's the flow through, and clearly everyone knows in retail, if your inventory doesn't sell relatively quickly, then you're in a markdown mode, and if you have to mark it down too far, you're not making any money. So making sure we stay attuned to the customer, again, I'll come full circle back to that from a retail perspective, staying attuned to the customer, making sure you stay relevant, making sure you stay trend right, so that what you buy will sell and will sell at full price is the art.
Wade, what about you guys for investments? And you got to be watching the competition, what they're doing. So how are you kind of making those decisions?
The question is so contextual, I think, depending upon, what part of the business you're
Right,
looking at.
that's true for you guys, yeah.
But I think, we look at everything through really three filters. I'd say the first one is the obvious financial filter. And then the strategic filter, which is not so obvious because, you really have to think through the deep logic of what are your core capabilities, where's your right to win, where's competition going, where do you have to be. And I think finally the third filter is really understanding the realism of can you execute. Do you have the right capabilities to be able to implement your dreams and things that look great on paper. So, but it usually starts, I would say, fundamentally with the core outwards, right? Things that reinforce your core, things that build off of your capabilities, things that are going to take that and embellish it for the customer experience or give you some other form of competitive advantage are typically the best places for us to start. And not being an R&D-led company like 3M, most of that actually happens in F&A. We do all the strategy, all the M&A, all the biz dev, all the market expansion. Because I think the finance function in general is probably the best positioned, not only to see how strategy should unfold, but to understand how value should be created and can be captured. But I think it is so contextual depending upon the business and also the part of the business. And I guess the last thing I'd say is, it's also not just the what to do, but the how to do. So we're doing a lot more partnering because I think, as was said earlier, there are just a lot of other companies that either understand their domain better, or they're very technical, or in a lot of markets where we go into, our model is never replicatable. Exactly. So you need to take an ownership stake in someone else who can run the play until you can learn each other. So I think that may be even harder than the what. It's the how.
Do you find yourself often the ideas come to you and you're saying, not so much because it doesn't make sense? Or what's your role in all of that?
I probably wear two hats. One hat is to kind of screen through and cut out 90% of the things that don't make sense, but also to educate, because a lot of times people will have a good idea, but they don't have the abilities or skills to think through, does it create and capture value or not? Or is it just interesting? And I think you can walk people through that whole thought process. But like I said, also in our context, probably half my job is to find those opportunities. And then even take those through my own people as a filter.
Right.
But, I think it's a bit of a wing walk. But I do think it's, one of the key, most important things to me of strategy which links very much to this investment, is trying to help everyone in the organization understand how to think through the process of how ideas ultimately capture and create value or not. Again, it doesn't make sense financially. Is it strategic, and what do we mean by that? And finally, how realistic is it that we can execute with excellence?
I want to open up our panel to any questions, or we can continue this discussion. But does anybody have some questions for anybody up here on our panel? It's a quiet group. Competition. I think all of you, and I especially think of, well, all of you, but the retail space, you've got to watch so closely what's going on in everything in the retail space. Mary, are you constantly kind of looking over your shoulder? Because it's not just, the bricks and mortar. Are you constantly looking at Wade and what he's doing? No, but seriously, I mean, it's just such a battered space.
Retail is highly, highly competitive. There's no question about it. And because of the nature of our business, we compete with lots of types of retailers, whether it's the mass merchandisers, the drugstores,
Online.
the grocery stores, online, convenience stores, gas and convenience combined. So we have a broad competitive landscape. And when economic times are tough, it does get more aggressive. People are more promotional. People are thinking creatively about their own business. People are all striving to win with a customer that has a tighter budget than they once had before. So it's a challenging environment. So yes, we are constantly looking over our shoulder. I would say we spend more time focused on the customer, because we believe that's how you will win, is being relevant to the customer and what they're looking for. And if you can offer that, that's how you will win. If you spend too much time worrying about the competition, you become a follower. And so you spend time, so you spend time wondering what are they doing, and then you find yourself following what they're doing. And the way to win in the marketplace is to lead, not necessarily to follow. So you want to understand what the competition is doing, and certainly you can get great ideas from the competition, but we don't want to find ourselves in the position of following.
Fredrik, there was something you had said to us on our conference call, and I think you said it takes about a keystroke to change a price, but years to change a culture, which is something you've already addressed. I mean, as a railroad, you're thinking you don't really have a lot of competition out there, right? Because it's expensive to get a railroad going. But there are options out there. There's barges, there's trucks. There is competition.
Yeah, I mean, absolutely. And that's one of the things, obviously, that we're going through. It starts with the customer, and that's really part of the culture change. I mean, if you look at our business today, 40% of our volume is intermodal, meaning that we're competing directly against the truck. And in order to compete in that sort of market space, and that's probably up from 20% a decade ago, we have to really change the way we think about it. And the good news is, and this is the paradigm shift that is occurring, a better service product is not only better for the top line in terms of growth and in terms of pricing, but it's also better for the cost structure. Our asset turn times today are significantly different than they were before, and historically there was always this difficult conceptual thing to think about, that the better service product, as I am more on time, that would be a better cost structure as well, and that's what we're finally getting through, and a significant amount of results from that.
Dave, 50,000 products you said earlier, and most of your sales, 2/3 outside the United States. Emerging markets are a big area for you guys, and they're pretty good at copying things. So you've got to be very careful, I'm assuming. Even though you've got R&D, I think your second biggest R&D is over in China.
Right.
You've got to be careful about what the overseas competition's doing.
And if you look at competition for us, we have participated in so many markets. Somebody says, give us your top 10 competitors. It's a difficult thing for us to do.
Which category?
Because it depends on the business, right? Yeah. But basically it goes back for us to the principle, which is we tend to lead with innovation. We tend to define new categories and new products, which then others, whether it be in emerging markets or traditional competitors, will then look at and try to emulate and eventually compete with us. So again, it goes back to the model we have, which is we assume that will happen, and therefore we don't hesitate. If we can come up with something new, we push ourselves to do that, to replicate and disrupt ourselves, because we know if we're not doing it to ourselves, somebody else will. If you then move into emerging markets where oftentimes the the norms of contract law are not as well respected and developed as they are in the more mature markets. We're thoughtful about what we do in those countries, but at the same time, we find that when we put local R&D capability in local manufacturing, we can innovate, we can gain a customer base which is local companies, whether it be in China or India or Brazil, and we can develop very strong partnerships with them to solve their most difficult technical problems. So in the end, yes, there's the issue that we've always dealt with, which is people who are trying to replicate what we do, and it goes back to a model where you just keep on that treadmill of innovation, and you can't get complacent, because you know when you do, that's when we lose our position in those markets.
Wade, when it comes to you guys watching the competitive landscape?
I'd say everything has mostly been said, with maybe the one little twist, which is, you know, there's this kind of definition of a dilemma, right? A dilemma is a problem that you can never solve, only manage. And lots of times our customers are our competitors. Mm-hmm. Like PBMs, for example, where they want, you know, mandatory mail, and we go, you know, and
If it's a back and forth, there's some stuff like that.
Yeah, for sure, right? And it can be true even in a CPG context where you're doing your own brand, but you know, you've also got suppliers that you're working with, but on the other dimension. So I think those are probably the trickiest ones, especially in a I would call the ecosystem of healthcare, mm-hmm. where there's all sorts of players and all sorts of motivations, and how do you weed through that so that you can be constructive, and everybody can win and be successful.
What I want to ask you about a little bit is your future business models, and I think this came up when we did the conference call together. I think it was Wade, I think it was something you kind of wanted to know from the panel, where they see their business model in 10 to 15 years, you know, amplification, acceleration, or something that could be radically different. Because if you don't change every 5 or 10 years, I think you said you're toast. So since you brought that up, where are you guys going to be in 5 to 10 years?
You know, we both what we're doing to kind of refresh the chain. If you've been to, you know, here in the financial district, there's a flagship. You can see where the chain is going from a consumer experience, and like I said, we're getting much deeper in healthcare. So now, in the U.S., we're participating at 40 cents on the dollar, and we're trying to influence the entire dollar through prevention, through lack of, you know, readmissions, but also globally with our partnerships through Alliance Boots and our partnership with AmerisourceBergen and the ultimate merger with Alliance Boots. I think in 10 years we'll probably be in 50 countries. We'll be going to 500,000 pharmacies, independents, our own pharmacies, doctors' offices, hospitals, every day in every one of those countries. We'll have the biggest own footprint. We'll have the biggest partner footprint. And I think we'll become the world's biggest healthcare delivery system, for not only for prescription drugs, but also for vaccinations, for lab things, and for other services and other information. And I think that's what I see for us 10 years from now, and I think we're a good way there.
Mary, for Family Dollar.
Why?
Can I still get things for $1 in 5 to 10 years?
Well, you know, and it's interesting because
That's a good question.
we do have dollar in our name, but actually even at this point only about 30% of our offering is $1, and I would say about 70% of our offering is national brands, and most things cost more than $1. And I think we will continue on that path. Our aspiration is to be the world's largest discount, value-oriented, convenient retailer. So our focus is on value and convenience, and we will continue to change and morph and evolve our business inside the store. We will still, you know, based on what the customer wants. So again, that's our focus, is staying focused on the customer. And to your earlier point, consumers can be very fickle. Mm-hmm. So what the customer is going to want, you know, 5, 10 years from now, is hard to say on the inside of the store. But I think when I look at retail, I think the U.S. has gone through a bit of an evolution where at one point people wanted the big, gigantic, 100,000 square foot store where you could go and you could get everything in that store if you had enough time. I think if you look at, say, the European model or other places where smaller box retail has thrived for many years, mm-hmm. where people are very focused on, I want to go in, I want to get what I need, I want it to be the quality that I want it to be, but I want to get it in 10 or 15 minutes and be done. That's our sweet spot. And so I see us continuing to focus there, and on the inside of the store, making sure our offering is relevant to what the customer wants.
Can you do it organically, or do you have to think about acquisitions or?
You know, right now we think that we can. We are always open to looking at strategic partnerships and acquisitions, mergers, whatever might come along. So we're not closed to those opportunities, but we really believe we can grow our business the way we want to organically.
I'm going to pick this up in a second, but I guess someone's got a question, please.
Yes. Hi, Rebecca Schechter from State Street. I have a question that's a little more internally focused, and I'm thinking about some of the changes that have happened in our finance organization, and I'd like to ask you to comment on how have you changed your financial teams, how have you transformed those, and how have you struck that balance between power and agility in a world that happens 24/7, where people work around the clock. Have you moved functions in and out of headquarters? Have you moved them offshore? How do you think of that, and what are the kinds of challenges you've run into?
Great question.
Sure.
Who wants to start?
Great question, and two things comes to mind. First of all, I think as a finance organization, if you as a CFO think that you are the one who's going to make all the decisions, the agility goes away. So I think as a CFO, I think one of the key things these days coming out of the financial crisis and the fact that the world is so integrated, things change so fast, it's more about the team that you build as a CFO more than who you are as a CFO yourself. The second thing I think is important, and that's something that I'm trying constantly to do, is to take resources away from the governance side, so the traditional finance, the tax, the treasury, the kind of the processing side, and try to get efficiency there through technology and move more resources over to guidance. Embed my finance team with the decision makers, if it's the engineering team, the transportation team, mechanical team, sales and marketing, and embed those. I heard a new definition of MBAs today that I'm not going to use. I got to rethink maybe who I'm embedding. But I do think that having good financial analytics at the lowest level within the organization is critical to make decisions faster. So it's less about me, it's more about the team.
Anybody else?
Yeah, I'm going to just leverage off of what Fredrik said, because that's exactly how I look at it. I've been focusing on transforming my team to better partner with the business. So to understand the business, understand the strategy, and partner with the more creative side of the business and add a financial perspective. So to help make sure that the decisions we're making about where we take the business will produce the value that we think it will, and will deliver the results that we think it will. And I try to do that myself within the CFO role by partnering with our CEO, partnering with our president, really focusing on the business strategically, more with a focus on analytics and what's the outcome of that going to be than reporting and those things. So.
I agree with everything said. One thing, because we had some ancillary functions that didn't necessarily consider themselves finance or finance and accounting, we rebranded our function VCS for Value Creation Services. And the notion that we try to articulate is that, what we're really here to do is to, create and capture value. And on the stewardship side, we're trying to streamline and minimize as much as we can that's not value added, but so that we can put more time on the other side. But at the end of the day, I kind of liken it to the people it's like putting water in a bucket. Mm-hmm. When you're doing business leadership, when you're partnering, when you're creating and capturing value through, M&A or a lot of other things, you're putting water in the bucket. But the other side of what people do in our activities, the stewardship side, is really like making sure that nobody pops a hole in the bottom of the bucket. Because both are equally important. But again, I think getting a good team, embedding them, putting in more resources, taking out more transactional activities is key. But I think it's also centering everybody's mindset that we're here to create and capture value, and we do it in different ways, but that's the mission every single day.
Dave, you have any thoughts?
So the thing that we spend time on is if you think about finance function, we inevitably have a seat at the table, and we bring data to the table. They look for us for information, financial information, and I think the key opportunity for us as a finance team is then to take that, to interpret that in a way that can help our business leaders really make decisions, and also to have a point of view. It's not just about being at the table with the data, but it's about having a thoughtful point of view. It's not always just the answer is no, but really how do you think about risk and the trade-offs and the opportunity is what we really try encourage our best leaders to develop that point of view.
Any other questions? I think you had a question right there.
Hi, Mohan Srinivasan, Antenna Research. I have a question on cash and short-term securities. Like, it gives you a lot of flexibility, and it gives you the agility, and it gives you a lot of, peace of mind. But at the same time, carrying a lot of cash on the balance sheet could be a drag on your share price, just like you see with Apple. So do you use any metrics as to what would be the ideal amount of cash and short-term securities you would like to carry on the balance sheet?
Anybody want to take that? Dave, go
I
ahead.
can take it, yeah. So in the case of 3M, as I said earlier, we do traditionally have a very strong capital structure, which we think is an important component of our sustainable success. And in the area of cash, after the recession, we allowed some cash to build on the balance sheet. This year now, what we've done is we've basically adopted a view that we should be minimizing to zero the cash to the extent we can do that tax efficiently. So we've taken our U.S. cash balance from over $2 billion this year to zero. And in the case of the international cash, we have about $4.5 billion, which we continue to look for ways to deploy. And the good news is there's a lot of growth internationally, so you can build out your network internationally and reinvest that. But our view is, as you just described, this weights down your return on capital. We have plenty of access to market liquidity if we need it, even in the event of a significant downturn as occurred in 2008. So our view is there's really no reason for us to be carrying an excess.
Anybody else?
Yeah. Well, I would agree with that as well. We don't carry a lot of excess cash either. Our priorities are to use our cash to invest back in the business in the ways that I've already talked about. And then we do have a dividend program. We've increased our dividend for 30-something years and plan to continue to do that. And we do buy back shares. So we believe in using our cash to return value to shareholders. Now, that said, we have the luxury of doing that because we have a strong balance sheet as well. And for a company our size, we have low debt. We have credit facilities that are largely untapped or have a lot of dry powder. So that allows us to then operate, with minimal excess cash.
Just to wrap up, since the whole theme is, we talked about powerful companies that need to be agile and agile companies that kind of need to be to grow up. For the CFOs and the finance professionals that are out there, what would be kind of your final thought and piece of advice to them?
Me first?
Yeah. Sorry, that's what happens if you get stuck next to me.
I think, part of agility, especially in a big company, is learning how to, change the tires while the car is moving. And that's the trick, right? Maybe in a private company there's more options, or maybe in a very distressful time there's more options. But in general, every company is going to have to keep morphing and transforming itself. And in getting people to see the vision and move to it while they don't forget they have a day job to keep the car rolling is really difficult. And I think that a CFO in a finance organization is in a good position to help with that wing walk. Mm-hmm. Because I think we probably get labeled too often as being the people who say no, when in reality, so much of our job actually is enabling things that actually make sense. But they have to make sense. And so I guess I would just say that it is that wing walk, and you have to do both, and I think we're in a good position to help.
Mary.
I guess what I would say is what I said before, which is staying focused on your customer. In retail, that's the consumer, but for every business, there's an end customer. And so staying focused on what your customer is looking for, that's what's going to drive success. So as financial professionals, sometimes that's hard because we're mired in the numbers. We're numbers people. That's where we live. We understand the numbers better than anybody else. But at the CFO level, pulling back from that and thinking strategically and thinking about the business overall and where the customer wants you to be is going to be a win. And then the second thing I think is the art of balancing the short term along with the long term. Because ultimately inside the business, you want to have a long-term vision. You want people to be engaged and behind that vision and moving toward that. But at the same time, if you're a public company, you have to manage the short-term expectations, and you have to find a way to try to deliver on those expectations. And when things change, you have to be transparent about it.
Dave.
Yeah, I share their sentiments. For me, the issue is, and it was talked about earlier, which is great ideas and innovation is fantastic, but unless you can execute and bring it to market successfully, it's really has limited value over time. So I view our job as financial professionals is to try to shepherd the business to create the environment to actually take great ideas and get them
Make 'em
into the
happen.
market successfully and create value for our own shareholders.
Fredrik, last thought.
Yeah, I mean, I echo Wade's comment about value creation. I mean, ultimately, that's what we're about. We have to recognize that value creation at the end of the day is what our existence within the company is there for. And we also have to fight the urge, I think, as CFOs, as finance professionals, we don't need to know every detail before we make a decision. We love the numbers, we love the facts, but that 80-20 rule is a simple remind yourself about with experience around you, even though it doesn't necessarily tell the whole story when you look at the facts, if you have enough people around you that can gather the experience, that 80-20 is enough to move forward, because otherwise you will never make a decision.
Thank you so much, Fredrik, Dave, Mary, Wade. We really appreciate it. Terrific
Thank
panel.
you.
Thank you.